So we are going to look at another question from the pre-mock. So we are left with two sections in numbers, and I'm going to attempt one of them, or maybe if we have time, we'll do the second one as well. So I'm going to start with the third question, which has to do with the risk management, because usually risk management doesn't miss in an exam. So if you understand it, that means that you are, at least you have a better chance of picking a question that you are able to do. Given that the exam is compulsory, that shouldn't matter really, but it at least gives you a higher chance of, you pass section A, you pass one number in section B, and you struggle with another number, you'll be better off. So the question you're looking at is called Stokewake, and they have given us two exhibits for it. And of course, the first thing we do is to look at the requirements. And the requirements are saying, calculate in terms of the results of the, in percentage terms, the results of the hedging strategies that are being considered for 36 million loan. The central bank base rate increases to 4.4%. So your calculation should demonstrate the rates at which payments between counterparties should be made. That is one thing. And then comment on the results. And of course, discuss the advantages and drawbacks of the interest rate swaps compared with credit collars, including acceleration of the risks involved. So from here, you can see that there is some interest rate swap to be considered. Then there is also traded collars. We are going to compare these two. But then we have a 36 million loan that we want to actually hedge. So these are the requirements. So right away we go and look at the risk management for Stockwake. So it's a large cosmetics company. The Department of Treasury uses a variety of derivatives to manage the interest rate and commodity risk. The chief executive has been considering how the Treasury Department uses derivatives. He understands that the purpose of derivatives is to hedge risk and wants to be sure that using derivatives avoids financial risks as far as possible. So now, what's the hedging that has to be done? So when you check through here, so that one has just been a backstory. There's not really much to pick for our solution. The backstory was for this kind of question. And this is a question that says that today is 1st April. So today is 1st April. Stockwise plans to borrow an amount of 36 million on 1st September. So you want to borrow 36 million on 1st September. So how many months are those? So April, May, June, July, August. The next 5 months. So it's always important to know that you are borrowing for the next 5 months, because some of the choices that we make, when we make them, they normally come with us choosing the period of borrowing and also the rate that is going to apply. So, but we are going to borrow for the next 5 months. Then we don't know for how long the borrowing should be, but at least we know we are starting it in 5 months' time. So the loan will be for another 5 months. So it means that we borrow it in the next 5 months and we pay it after another 5 months. So that's 10 months from now. So although in recent years, Stockwave has been borrowing between 1 and 3 years. So this is a shorter one, because they've been borrowing between 1 and 3 years. That's okay. Treasury Department has decided to hedge the risk of borrowing as there's some uncertainty about how interest rates will change over the rest of this year. The current central bank rate is 3.9%. Most predictions in the media suggest that it could rise by 0.5 by 1st September. So it could rise by this March. So we need to see, although there's been a couple of predictions that the central bank base will fall. So now, when it comes to interest, you need to realize what do you worry about. Because first we are going to borrow. So our worry is that the interest rate will rise. And that's what most people also are saying. But there is also a chance that it could fall. And if it falls, and we have hedged, we may not benefit from the fall depending on how we are hedging. So we need to understand that. But you also need to understand that as a finance manager, your role is not to get profits from this arrangement. It's just to remove uncertainty. So that also should come up when you are discussing. So Stockwake can currently borrow at floating rate and with central bank base rate plus 60 basis points. This is how much you can borrow at. Central bank for plus 60 basis points. And we know central bank right now is at 3.9. So if it increases by 0.5, it will become 4.4. Then we add 60 basis points. So we add 0.6, and I think that should become 5. So now, Stockwise Treasury Department is considering hedging interest rate risk by using, now we are saying we are going to use an interest rate swap. This is one of the hedging methods through the Stockwise core bank. Then also we have a collar on options on interest rate futures. Just call it a collar, an interest rate collar. Because sometimes when people see the word collar, then they see options, then they see futures, then they get confused. But when they say a collar on options on interest rate futures, it means that you are going to sell and buy at the same time, so that you create a ceiling and a floor. That's how you get a collar. The reason we do that is to reduce on the premium that is paid. We shall see how that works. So Stockwise Bank has found a possible counterparty for swap with Stockwake. The counterparty can borrow at an inflating rate of base rate plus 140 basis points. This is what the counterparty can borrow at. Or a fixed rate of 5%. Stockwise Bank has quoted its normal fixed rate of 4.7 to borrow. The bank would charge a fee of 10 basis points to each party individually to act as the intermediary of the swap. So there is some charge for the fee that they are doing, the service charge for being intermediaries. So both parties would share equally the potential gains from this swap. That is also something that is important. Usually that's what happens. So even if they don't tell it to you, that's what you assume. So that's the swap. And we can just right away go to the swap. But let's first understand what the scholar is all about. In an exam, if you realize that the swap is, you know how to do the swap and you read the swap, and you could first go and utilize this information, calculate the swap, and come back, pick the caller. So the callers, they have given us options on 3 months September futures, $1 million contract size, option premium given to you here. And they have given you 2 strike prices, and they have saved you the trouble of having calls and puts for both of them. So they have actually been good to you. So it means that when when you're looking at calls, you use 96 strike price. When you're looking at puts, you use 95.5 strike price. In other exams, they have been giving you calls and puts for both strike prices, and that would mean that you have to decide how you're going to deal with that. But here they've given you simplified. Current 3 months future price for September is 95.62. And even this one, they have calculated it for you. So they have been very nice for you in this question. So futures and options contracts are assumed to be settled at the end of each month. Basis is assumed to diminish to 0 at the contract maturity, the constant rate, based on the monthly time intervals. All this information they give us is what we normally assume if they don't tell us. Also, there's no basis risk and no margin requirements. That's also another assumption we normally make. So in this case, the question did not ask you for assumptions, and so they have given to you all of the assumptions. It's important to know that if we are writing this, since you are going to calculate and possibly come to a comment in part B for 9 marks, you should put all those things, including what has been given as assumptions, in that part B as we're discussing. So that you make sure that you get your marks for these 5 marks for professional skills. So let's go and look at how this is going to be done. So we are going to start considering, first of all, the swap. Then from there, we shall go and look at the caller. So the swap, for the swap, remember what happens with the swaps you need to know is that you have 2 people and they both want to borrow, but one of them is able to borrow. Both of them can borrow at fixed and also floating, but you'll find that it's better for them to go do it the other way around. So if you look at the let's look at the question is called Stockwake. So I had already given you some idea of how to do this. You can always first consider what each one wants and what each one can get. But there is a shorter formula that we also saw in the examiner's solution, whereby they just look at the rate that they pay, the differential rate that is paid for both of them, and then you see which one is beneficial. So we have Stokewake, and the counterparty has not been named, so we shall just call them counterparty. So if they borrowed at fixed rate, Stockwake has been quoted. What was the quote? 4.7% at fixed rate. Then the counterparty has been given 5%. So you can have the difference. The difference is 0.3%. If we are doing what fixed rate. Then when you got the floating rate, then Stockwave can borrow at, we told us that it was going to be base rate plus 60 basis points. So base rate plus 60 basis points, which is 0.6%. And then counterparty can borrow at base rate plus 140 basis points, so plus 1.4%. Which means the difference is just 1.4% minus 0.6%, which is 0.008. Yes. Yes.
The 1.4, where have we got it from? 1.4%.
the counterparty can borrow at an annual floating rate, the base rate plus 140 basis points. Yeah.
Okay.
Okay. So you can see that in both situations, Stockwave gets a better rate. Okay. Borrows at 4.7 at fixed rate, even here 0.6%. So it's better off in both situations. But it's better, it's much better when actually we use when floating rate. It has a beta differential for the floating rate. Okay. So because there is a beta differential for the floating rate, therefore, the idea is that Stockwake borrow using a floating rate, and the counterparty using a fixed rate, and then they swap the interest payments. So when they do so, there will be a gain, and that gain is what you need to calculate. Okay. So now the gain is the differential. First of all, this difference here, that's the first gain of 0.5%. But the gain for Stockwake is going to be, now it would have been this 0.5, and of course they share half of it. Because remember, they said that the two companies will share 50%. So ideally you get half of that multiplied by this differential, but you have to remove also the costs that the bank is charging. The bank is charging 10 basis points to each party, which means it's charging 20 basis points on both of them, 0.2%. So which gives us 0.15% as the gain. Okay. So after getting that gain, yes.
Why did you do 20 basis points yet it's the gain for Stockwake?
Yeah, the bank has to, because the way I'm doing it is that they have to benefit on the remaining portion of the gain. So this is the gain, but because the bank is charging them 20 basis points, you have to remove, yes, from this one. And what remains is now shared equally between the
two. They will share. Okay.
Yeah. Okay. So from there now we can calculate.
Albert,
Yes.
Albert, just help me put the cursor back on the 0.15.
Okay.
Oh, okay, good. Thank you.
Yeah. So now we can look at the swap results on both companies. But of course, you really don't have to even calculate the one of the counterparty, because all you need to know is Stockwake, what's happening in Stockwake. But we can do them both so that you see what's also happening to the counterparty. So Stockwake and counterparty. So remember that we have said that the rate that would have been used without the swap, because rate without swap, of course, Stockwake would choose to use the yes. So the rate without swap, Stockwake would have chosen to use 0.3. Okay. I mean 4.7%, because remember we have just said it here that it is beneficial for Stockwake to use a floating rate to borrow, and counterparty uses a fixed rate and then they swap. But had they not done that, then Stokewake would have used a fixed rate of 4.7%. And the counterparty would have used the floating rate of B plus 1.4%. That's what would have been done. Okay. Then, of course, the benefit, you bring the benefit that they have both benefited from, and it is 0.15%. So, what is the net result now of this? Is that now, instead of this one borrowing at 4.7, it's now going to borrow at 4.55%. And this one, instead of borrowing at base rate plus 1.4, it will borrow at base rate plus, what is 1.4 minus 0.15, 1.25. So plus 1.25%. That would have been the net result if you consider that benefit. But now when you consider the swap, now the rates will be different, because you see, since we say that it's better for us to borrow at floating, so we shall borrow at base rate plus 0.6%, and then this guy will borrow at the fixed rate of 5%. Then after we swap, remember this is what we do, right? So this is what we borrow, but then when it comes to payment, we change and we use the other. So now what normally happens is that we want to put it such that this company, Stockwake, uses because for it prefers a fixed rate. So the first thing that has to be done is that you have to remove the what? The counterparty will need to pay the base rate, so that this person now becomes fixed and this one becomes floating. So the payment here, there's a base rate, and I'm not using the sign convention very well, because otherwise then it would, okay, let me use the sign convention very well, because what happens is that when you are talking about the payment, the rate itself is negative. So maybe I can put this one as minus, so that at the end of the day, of course, the bank charges 0.15, 1 basis point, which is 0.1%. Even here, 0.1%. So the net result will be, so now remember, start with base rate, and this base rate now has done what? The net interest that we have seen, we see net interest. Net interest, we have said it's going to be 4.55. Okay, so 4.55%. And this one, this rate plus 1.25%. So now this just shows you how the swap would work. So this person now will have base rate plus 1.25% as the one they're paying. This one will have to pay 4.55. So now what has caused this to be like this is that when this base rate goes away, you remain here with 0.6 plus 0.1, which becomes 0.7. So that is 0.7, but there's also the 0.15 benefit that comes. So ideally, you really don't have to do this last part here of showing how the swap is going to work, because all you want to know is that at the end of the day, Stokewake is going to pay 4.55. So this other last part is to just show you how does it happen? How does the swap now materialize? So because you want Stokewake to have a fixed rate, you first remove its what happens is that the counterparty will pay the base rate to Stokewake. So that's the base rate is always handled by the counterparty, and Stokewake is only having to deal with now the fixed part of that interest. And now that means that the counterparty is now also dealing with now the floating part, because it is paying that floating part. Whenever it changes, it's the one that pays. And also they will have to pay this interest. But of course, for you for them to reach 4.55, as we said, this point here is 0.6 plus this 0.1, that is 0.7. So, and they have to benefit from 0.15. So 0.7 minus 0.15, you have 0.55. So they will have to pay another 4%. The counterparty will be paying 4% plus this base rate. But let's not worry about this part, okay? Let's not worry about this part. Just demonstrating how the swapping itself will be done. So let us go to the other one of the callers. So now when you look at the callers, so the callers, they've given us some kind of options. Now, remember we said the caller means that you have to sell and buy at the same time. But before you do that, you need to first of all realize if you are just going to use an option, what would you do? Would you buy or would you sell? And would you buy sell puts, or would you buy calls? I mean calls, because there are two things here. We have calls and have puts, and of course, when you use calls, that means that you are buying an option to sell. I mean to buy, and when you use puts, you are buying an option to sell. So normally we say that if you are borrowing money, then you normally actually buy put options. Okay, when you remember, we went through some kind of analysis and we came to conclusions, and the conclusions that we came up with, and write them here, that when borrowing, you buy put options, and when depositing, you buy call options. And it makes sense when you do that, because you see, when you're borrowing, you are worried that the interest rate is going to increase. And therefore, if the interest rate is going to increase, the options price are going to decrease. So you normally hedge the opposite way around. So if you think that the options price are going to decrease, then you hedge against that by saying, okay, but what if they increase? And if they increase, what is beneficial for you would be to sell those options later on. So you buy an option so that the option lets you sell the options in future. And that means that if they move against your favor, you have a profit that can counteract to the movement that has occurred. So when borrowing, you always buy put options, and when depositing, you buy call options. And that is if they were normal options without callers. But because they are callers, so we buy put options and sell call options when borrowing. And then when depositing, we buy call options and sell put options. Now, the reason why we do buying and selling at the same time is that when we buy, we pay premium. When we sell, we receive premium. So that balances out how much premium we are paying. So we are going to, since we are borrowing, we are going to deal with this one. So we are going to buy put options and sell call options. So, of course, you need to know at how much. So we shall buy put options. We are buying September options, remember, because those are the only ones that we have, but also because our borrowing starts in September. And it starts on 1st September, and these September options are at the end of the month, so there's going to be some unexpired basis. So we are going to buy put options, and put options have been put at 96 and at 95.5. 95.5. And sell call options at 96.0. Now, when we buy options, we shall pay premium. So paying premium of 0.234. And then when we sell, we shall receive premium of 0.219. So the difference is what we shall end up paying. So now, after having known that that's what is going to happen, we need to first of all know how many contracts, because remember these options and futures are usually given in contract sizes. So how many contracts? And we say that since these options and futures usually are for 3 months period, you have to determine how many months you're going to borrow for, which we said it's going to be 5 months. We are going to borrow after 5 months. So that's when you are buying the option. But the contracts, so to get the contract sizes or number of contracts, you get the money that you want to borrow, 36 million. 36 million. Divide it by 1 million. That's the contract size. Here, 1 million. But then you multiply it by the period that you want to, after which you want to borrow, which is 5 months, but divide by 3. Because we said each of these options is a 3-month option. So we have January, March, June, September, December. So those are the 3 months each. So that's how it tells you how many contracts you need. And here they have given us 60, and this is accurate. So we don't have to have under or over hedging. So we are going to deal with 60 contracts. This question was simplified in that manner also. You don't have to deal with over hedge or under hedge. But now we need to calculate the basis points, the basis. So we need to first determine the current basis and then the unexpired basis. So current basis, we are going to look at the price of our interest rates right now, and then we'll subtract the futures price. So right now, what's the price? Since the central bank is at 3.9%, the price is going to be 100 minus 3.9, because the price of the options for interest rates is usually 100 minus the interest rate itself. So they've also given us the futures price, and they said it was going to be 95.62. So that is the current basis, 0.48. Then the unexpired basis. Now remember that the borrowing is happening in how many months? So today is 1st of April. So from 1st of April to 30th September, those are 6 months. And we know that we are going to borrow in 5 months' time. So there will be 1 month left. So it will be 1 month over the 6 months multiplied by this 0.48. That's the unexpired basis, 0.08. Okay. So after getting the unexpired basis, then we can now also look at how much premium should be paid. Because as I told you, we are going to pay 2.34, but also receive 2.19 or 0.219. So the premium that is actually paid is going to be the difference between these ones. But remember, these ones are given as percentages. So 0.234%. Okay, so what's the premium payable? It's going to be 0.234% minus 0.219%. So for how many? So now we can determine how much money, right? And how much money is basically the contract size multiplied by the 60 contracts that we have come up with. But this premium is going to be paid because these are just 3 months. You know, these collars or the option prices is usually 3 months, like you said. So multiply it by 3 months out of 12, which gives us the premium as 250. So that's the premium payable. So after getting the premium payable, now we have been told that they want us to look at this when the requirement they said when the bank rate increases to 4.4. So it means that if the bank rate increases to 4.4, so when bank rate increases 4.4%, so what will be now the futures price at that point? It will be 100 minus 4.4 minus the unexpired basis of 0.08. So it will be 95.52. So remember, we are doing callers, so we are going to buy a put and also at the same time sell a call. Of course, if the exercise price is the one when you are buying puts, I think we already wrote them here. When you are buying the put is 95.5, and then you are selling a call is 96.0. Then the futures price, we have just calculated it at 95.52. Now, the question now is, should you exercise? So, and this one, you normally look at it this way. If you have an option to sell at 95.5, but the market is selling at 95. Is buying at 95, you can sell on the market at 95.52. Would you exercise? Would you exercise, Barbara? Just tell me what you think. Esther, do you exercise?
You said, can you recap the question?
I'm saying that if you have an option to sell, because the put option is the option to sell, right? If you have an option to sell at 95.5, but without using it, you can sell at 95.5 too. Would you exercise?
No.
No. Okay. Because you can sell at 95.5 too without the option. Therefore, the option is not useful for you at that case. What about here? Now, this one is not on your decision because you are the one selling these options, right? If somebody can get the option to buy at 96, but the market is buying at 95.52, would they exercise?
No.
No. Okay. Because why would you buy an option to buy at a what? A higher price. So in both cases, you're not exercising. And when that happens, it means that you're not going to calculate things like the saving, whatever. No, in this case, there's no saving. So there's no saving, there's no loss in basis points. So that's all where it stops. That means that you're going to just buy this option, buy the put option, sell the call options, pay premium, but you're not going to have any saving, right? So you're not exercising it, but you can still sell the futures and you get some cut difference there. So, okay, so now what will be the borrowing cost? Because you have not exercised. Means that you are going to still use 4.4, right? You're going to use 4.4%, and then you have paid some premium, which we already calculated that you're going to pay. And then we shall see what is going to be the interest rate. So the borrowing cost will be 4.4% times the 36 million. But we are borrowing it only for 5 what? 5 months. But remember that we don't borrow at 4.4, we borrow at 4.4 plus 60 basis points. So that is what we are going to borrow at. So we shall be paying 750,000 as the borrowing cost, but we shall have also paid premium of 250. So we shall have made the total payment of 750 to 250. So therefore, if you put in terms of annual interest, it means that you're going to have this interest divided by 36 million. But now this is only for 5 months, so we need to scale it for 12 months. Okay, which gives us 5%. Okay, so now we can compare. We can compare with the swap and with the collar. So with the swap, ended up saying that we are going to borrow at 4.55, and with the collar 5.02. So of course, then you can now come to a conclusion which is better. Okay, but the conclusion here looks like we are better off using the swap. Okay, but remember, now you need to bring the discussion of the different reasons why people wouldn't use swaps and all, because swaps are nice, but they have the counterparty, and the counterparty might default. Okay, the counterparty might default on the swap payment, and then you enter problems. So now the reason why also the collar is better in this case is that it told us that although everyone is feeling that the interest rate is going to actually increase, there have been a couple of predictions that the central bank will fall. Now, if the central bank falls, then the collar becomes, you see, the collar is an option. Okay, being an option, it means that it gives you the right to benefit from the good movement. So if the collar is bought and the interest rates actually fall, then it will be beneficial to us than the swap. So you need to, like I said, you need to put that in consideration as making the choice. So then another thing they told us to discuss as part of this comment was the advantages and drawbacks of using interest rate swaps and collars, okay, including the risks that are involved. So what are the advantages of using swaps? I'm waiting for you to give me some advantages of swaps. Okay, swaps being that you normally arrange them with your bank, there is no under or over hedging, they're over the counter. So you exactly hedge how much you want to hedge. That's one. And also, it is a little bit cheaper because,
But
yes,
sorry, what do you mean by like you hedge only how much you want to?
Oh.
Is there a possibility?
yes, it is. You see, when we did the calculation of how many contracts we needed for the callers, we got lucky and got 60 as a round number, right? But in the
Yes.
examples we have been doing before, we have been getting like 59.2 or 0.3.
Mm.
And this means that you either buy 60 contracts and you are over hedging, or 58 contracts and you are under hedging. So there is no perfect hedge. Yeah. But for the over-the-counter transactions, when you go to the bank and you tell them, I want to borrow 36 million and I want to hedge it using swaps, that's exactly how much they'll help you hedge. So that's the advantage.
Mm.
Yeah. And
so would you say with this one we expect to find like we don't expect to have like points on the number of contracts, like it will always be exact?
yes, for the swaps. Even there are no swaps, there are no contracts. Or completely, there are no contracts. It's just that you are saying you want 36 million. Okay, yes. Then the bank looks for somebody who wants to the same amount of money at that rate. Yeah. And other thing is that swaps, given that they're over the counter, can be for any amount. Imagine you wanted to borrow less than $1 million. And here the contract size is 1 million. It means that if you want to borrow 700,000, you still have to buy the entire contract. And then you would have overhead. But with the swaps, you just go to the bank, tell them, I want to borrow 200,000 and I want you to arrange for me a swap. That's why. So that's one of the advantages of using swaps. Then also
one more thing. That is in comparison to what? That's in comparison to
callers. Yeah. Okay. The ones that are actually traded usually are options, futures, callers. Those ones are the ones that have that problem. But if you are looking at swaps, if you are looking at interest rate forward rates, they don't have that issue.
Okay.
Yeah. So the other thing is that you can arrange swaps for a longer period than these 3 months that have been put in the options. Because you see, the options, as we said, they have 33 months of expiry. So they have March, June, September, December. But with a swap, you can go to the bank and you want a loan for 10 years, and that would still be arranged. The problem is the longer the loan period, the more risk that you are encountering because the default risk increases. So those are the advantages of swaps. We shall look at more when we look at the solution or when I send it back. But the risk that we just said, that there is counterparty risk. Okay, the person may default. And if they default, then you may have to still be paying your interest rate obligations even after losing money from the other side. So also, because we are in essence taking on by doing this swap, we are taking on a floating rate and swapping it with a fixed rate. We may actually be losing out because if the floating rate goes down, then we shall, after doing the math, we realize that, okay, we should have stayed with our floating rate and not swapped it. that's a problem. But as we said, as a finance manager, you need to just remove the risk, not to make profits. So I think that should still be understandable if that's how you remove the risk. So then also another problem is that, of course, swaps cannot be traded. But that disadvantage just depends on whether your purpose of trading was speculation. And also swaps don't give you an option. You have to exercise them even if the movement is not beneficial to you anymore. So those are the problems with these swaps. So I don't know if you have any questions, but I was suggesting we take a short break so that we do the last question.
Okay, thank you, Abba.
Yeah, so let us return at 6 minutes past 8. So let us look at the other question in section B. And this question, when you look at the requirements, they're asking us to calculate the adjusted present value for the project and evaluate whether the investment should be accepted or not. And then discuss the factors which influence the credit rating of Flatfig. Evaluating the extent to which this will also be important to the shareholders. So the first part of 13 marks is calculation, but of course, you are supposed to also evaluate whether the investment is accepted. So, and when they're saying adjusted present value, what you need to know, of course, you need to realize that when you see adjusted present value, means that you're going to calculate the NPV when it's all equity, and then you adjust it by the financing, which is the debt part. And usually there will be a subsidized loan, there will be a tax shield, and there will be sometimes the offer costs of that loan. So it's a very easy question once you start understanding the mechanics of how to get to the answer. Yeah. The discussion part is about how the credit rating is going to influence the factors that affect the credit rating, and how those factors will also impact the shareholders. So let us start with the calculation, and then we shall go back to that part. So this question is called Fluftig. So Fluftig. So what we are going to be looking at as part of Flatfig is the APV. But you need to now, of course, understand the company information and the product that you're investing in. So Flatfig is a company that manufactures electronic parts and large items of electronic equipment. Profits have been stable and have been increasing since incorporation, and has always kept on operating costs under control. It was listed on the stock exchange 2 years ago. So it's a new company on the stock exchange. That is important. The listing resulted in an increase in the number of shareholders, with new investors including some institutional shareholders. In a recent meeting with directors, the institutional investors said that they were content with the profit increase in the last 2 years, but wanted Flatfig to pursue investment in new products and markets to broaden its customer base and increase profits more quickly. Now, whether or not you agree with this statement should also come out in the solution. The board is considering how to finance future investments in the longer term. The chief executive believes that the company should take advantage of the listed status and issue loan notes. They are looking about loan notes. Understands that the terms on which the loan notes will be issued and the likely success of the issue will be determined by the credit rating of Flatfig. he wants to understand the extent to which the factors that influence the credit rating will be similar to the factors that influence shareholders' opinions of Flatfig and the management. So that's where the second part of the question is coming from. So if you look at the new product that we are going to be producing, now the board is currently considering proposals for a new investment in communications units with immediate expenditure of 160 million. The investment will also require immediate investment in working capital of 20 million. The working capital requirement can be expected to increase annually at the start of year 2 to 4 by the following expected rates of inflation. So, if we are to note what is important here, expenditure immediately, 160 million, then working capital of 20 million, immediate, but it will grow from year 2 to 4 at the start of year 2, which means the end of year 1. So don't make that mistake of starting in year 2. At the start of year 2 to 4, and this is how it's going to increase. And it will be fully recovered after the end of year 4. The director has a time horizon for 4 years and has forecast following post-tax cash flows from the investment. So year 1 to 4. And you can assume that there is no realizable value for the investment, which means that there's no scrap. The board is considering the following financing package. They want to use equity, 60 million. They want to use a bank loan, which is repayable in equal annual installments over project life. Interest estimated to be payable at 8% per year. Interest on the balance outstanding at the start of the year. That's a bank loan. It has not been very common to ask this question of this kind of loan because this is a loan which is amortized, but here we are. Then also a subsidized loan from government scheme over the project life, payable at the rate of 50 basis points below the risk-free rate of 3.2, payable on maturity. So those are the financing arrangements that have in place. Then there's also issue costs of 2% of the gross proceeds. Then be paid on the equity issue and on the subsidized loan. So issue costs are on the equity issue and subsidized loan. Then the tax payable is 20%. And it's payable in the same year. The finance director intends to use the adjusted present value method. And the cost of the equity financed part is 12%. As we said, in such a situation, we are going to have to calculate the NPV, the best case NPV. Then we bring in the financing side effects. So let us go to our Excel. We need to of course, look at the years 0, 1, 2, 3, 4. So we have the cash flows. These cash flows, they told us that they are post-tax. Year 1, they gave us in millions, so let us use in millions. So year 1, they are 32.4. Year 2, 32.7. Year 3, 66.9. And year 4, 56.4. Then the investment, they said it's going to be 160 million. And the scrap, they said it's 0. Then working capital. So working capital, they say that it is going to be 20, but it will increase by inflation of this. So we need the working for it. So let's put a working here. Working capital. So we have the years 0, 1, 2, 3, 4. So the working capital needs 20 million. Let us work in millions again here. So 20 millions. But it is going to grow by 8%, 7%, 5%. So we can say this one will be 20 million multiplied by 1 plus 8%. Then this will be 21 million multiplied by 1 plus 7%. And this will be this one multiplied by 1 plus 5%. And there's no inflation for the end of year form. So maybe we can make it 1 decimal place. Then we need the change.
Humbert.
Yes.
So we're putting the inflation on year 1 year. We are taking it that when they say year 2, the meaning at the end of year 1.
They said at the start of year 2. So that is the end of year 1.
Oh, okay.
Yeah. So the change is going to be just the difference between the two. So you just drag that. And then the final, yes.
People at Matt used to say Joe. I said Joe was a student.
So now this is the change in working capital. That's what we are taking. So we shall take 20 million to drag out. So all of it will be recovered at the end of the 4 years. So that's why we have here the 24.3 million. So after that, we have our cash flows. So from here, we can actually get our net present value at 12% using the formula NPV, 12%, give you the cash flows from year 1, then you subtract the initial investment. So the best case NPV is negative. That means that if you are only going to consider using equity, then you would not accept on that basis. But they want us to calculate adjusted present value, so we need to look at the financing part. Financing cash flows, outside effects. So, like we said, the financing side effects result directly from how we are financing. And we are financing using equity. We are financing using a bank loan and also subsidized loan. And then we also have issue costs. So we shall have issue costs as one of the financing side effects. So now the issue costs, they told us that is 2% of the gross proceeds. So remember, they say that the issue costs are on equity and on the subsidized loan. So together the equity is 60 million, subsidized loan is 70 million. So we are looking at 130 million issue costs. So it will be 2% of the gross. And I always tell you that when you are getting a loan and you want 10 million, you don't ask for 10 million because the issue costs will reduce it and you'll end up with less. So you always assume that the 10 million is what you should remain with, which means that we are going to say that the 90, it's not 2 out of 100, it's 2 out of 98, because what we are remaining with is the profit, is the loan after removing the issue costs. So we can put here our 60 plus the 70. That gives you the issue costs. And the issue costs here, let's make them negative because they are costs. So let's work with the one decimal place. That's 2.7 million. We're working in millions again. 2.7 million, that's issue costs. Then we are going to have a tax shield. And the tax shield is always on any loan that is paying interest. And we have two loans. We have a bank loan and a subsidized loan. So you can actually distinguish them by saying tax shield on the bank loan. Then we also create tax shield on the subsidized loan. So that we calculate them individually. So if we start with the tax shield on the subsidized loan, it's always better, or it's easier to understand. So we are going to be paying at 50 basis points below 3.2. So we are going to be making we have a subsidized loan, and instead of paying 3.2, we are going to pay 50 basis points below it. So we are going to pay, I think, 2.7%. And we are getting 70 million, so 2.7% of the 70 million, and we are saving tax at 3%. So it's going to be, now, I am doing everything in this cell, but if it becomes too much for you to bear, then you can create workings. Because you see, we have 70 million, and instead of paying 3.2%, we are paying 50 basis points below it. Okay, that is the first thing. And we are saving tax at 20% because tax is at 20%. So, but remember, we are going to be considering these are present values. So we need to have an annuity factor because these payments are going to be made for years. So we need to create an annuity factor. And at this point, you need to calculate, multiply by the annuity factor. And this is one of those situations where I can say you can go to the tables and get the figure, but I am just going to calculate it here. Okay? And normally, what rate do we use? We use the normal borrowing rate. And what's the normal borrowing rate? 8%. So 8% power minus 4 divided by 8%. So hoping that I've used the brackets very well. So let's see. So this gives us okay, so this gives us 1.25%. The tax shield on the subsidized loan. Remember, we decided to use 1 decimal place. So if you feel like this is too much to put in one cell, you can create a working for it. And you just step by step go through it. So that's the tax shield on the subsidized loan, not the bank loan. Then we need to look at the one on the bank loan. So now tax shield on the bank loan, this one actually, as you saw, the bank loan is repayable in equal installments. That means that it is amortized. You don't pay at maturity the entire amount. So what you are paying is both interest and principal over the 4 years. So we need to first of all determine how much do you pay every year. So this one we are going to need the working. You're going to need the working and put your working 2. Tax shield and bank loan. So you'd have the years 1, 2, 3, 4. But before you get the years, you need to know how much are you paying annually. So you can have the annual payment. So now the annual payment, remember that we have the loan is at 50 million. So what we are going to do, we are going to divide the 50 million by the annuity factor for 4 years. So 50 million divided by annuity factor for 4 years, which is, again, you can bring it from the tables. So, but I'm just going to calculate it here. 1 plus 8% power minus 4. Then divide by 8%. Then I think I need a bracket here. So that gives me 15.1. If you are looking at 1 decimal place, that's what we are paying annually. So that means that we can say what was the opening balance. Opening balance is 50 million before we make any payment in year 1. Then we pay interest. I hope you guys know how do you amortize these things. They have been taught to you in FR and I think FA. So the interest is 8%, and they say that we are paying it on the calculated on the balance outstanding at the start of the year. So on the 50 million, 8% on the 50 million. So we are going to work with the 1 decimal place. So that is 4. Then the repayment is the 15.1. Remember, we already calculated it. That's what we are paying every year. So just going to fix it and drag it all through. That's the repayment. And then you can have the closing balance, which is basically going to be the sum. Okay, so then we can have this now become the opening balance for the previous year. So you can drag this and drag this and drag this. You can see that at the end of the 4 years, you have paid back the entire 50 million. Now, the interest cost is these ones. So we can bring them here so that we can get the tax shield. So the interest cost is this 4, 3.1, so on. Then the tax shield. Remember, we are paying tax at 20%. That's the tax shield. Then we are going to discount it. So we can actually from here come and say NPV at 8%. Then we do NPV. Then we put 8%. Then we give it the cash flows. There's no year zero, so we don't have to do anything of a sort. So which gives us 1.8. That's what we take here on the bank loan. So in this question, this is the only part that was a little bit challenging, the tax shield on the bank loan. Then from there, we also bring the subsidy. So the subsidy, instead of paying at 3.2, we are going to pay at 50 basis points less. So we are going to come here and say 3.2% minus 0.5% multiplied by the subsidy is at it's on 70 million loan. But then we are looking at the issue of no, that's not the subsidy benefit. Normal borrowing is at 8%. But for us, we are getting it at 2.7%. So that's the benefit. So now, normal borrowing is at 8%, but for us, we are getting it at we are instead of paying 3.2, we are even not paying this. So that's the 2.7%. And I can put this one. So this together gives you the benefit before you. So we are saving 4.3% by taking this loan. But it's on 70 million. And remember, there's a tax shield of 20%. So you subtract 1 minus 20%. So this is what you would get. But again, this is going to be for 4 years. So you get the annuity factor either from the tables or you calculate it. Okay, so which gives us 7.97. There's a bracket that I missed to put here. Okay, so that's 9.83%. So that gives you 9.8 as the subsidy benefit. So after getting that, now we are able to get the total. So total benefits is 10.2. From financing. Therefore, the APV will be the NPV plus the benefits. And you can see that even with the financing, even if the financing side effects, we still have a negative APV. So that means that the project should not be accepted. Okay, because even with the APV, we still are in the negative. So that's the calculation part and the recommendation that's given. So any other questions on that, or is it clear?
None from me.
It's clear.
No
Okay.
question.
Okay. Then course, the discussion part, we said it's not going to be accepted because the APV is negative. But you start from saying, remember, this is, you're going to write in the word processor. In this case, you can do this question as part, the whole of this part in, remember, they don't give you spreadsheet for part A or part B, they give you just spreadsheet and word processor. So you can go here and write part A, okay? Then you say the NPV for considering the financing side effects is minus 13.6 million, which means on that basis, the project should be rejected. Okay, so you can bring here appendix 1 because you named it appendix 1 in your Excel spreadsheet. Then you say, after considering the financing side effects, then you say appendix 2. That's what you have named it. The APV remains a negative 3.42 million, meaning that even with this financing, it should be rejected. Okay, so this is the most important information that you need to put in your solution for part A. But then you can now come and bring other aspects, because you see, that the financing we need some bank loan of 50. What if we were able to get 120 all subsidized? It would have been better for us. So you can bring that aspect. And you say, however, if we had got the entire 120 million subsidized loan, perhaps the project would have been worthwhile. You don't have to calculate it, but at least that is something that you can mention. Okay, so of course you go and look at the other points that are made on that, but at least you are aware of the fact that the project is not going to be accepted. Then factors that influence the credit rating. One of them is how profitable the company is. Because remember, credit rating shows you how worthy are you in terms of paying your debts when they fall due. So one of the things that is important is, are you making profits? Because when you're making profits, means that you have money that potentially can be able to pay the debts when they fall due. So that is very important. Profitability. The other one is the cash flows that you have. If you know that the statements of financial position don't tell you so much about the cash flows, they can tell you the cash that you have, but they don't tell you how that cash has changed. They just show you the opening and closing figures. But if you look at this cash flow statement, that statement can help you understand where your cash has gone and where it has come from. So the cash flows can help you understand whether you are managing your cash very well, and therefore you are not going to have so many issues. So that is important for you to mention. Then another thing that affects the credit rating is how financed you are. Are you financed using debt or equity? So basically the gearing. The gearing is high, then you may have issues with the liquidity because you are paying interest rates and all that, and therefore that may reduce on your basic figure that you're going to get in terms of the debt and all that. So the credit rating might go down, but not only financing gearing, but also operating gearing. Operating gearing is looking at how much of your costs are fixed and how much are variable. That also can affect your rating, because if you have so many fixed costs, then it means that when you are in times of like reduced profitability, you still have to pay those costs regardless, and that may put you under constraints or under strain. So those are the factors. Now, I have not discussed the part which says how do those also how are SMEF those ones that are the important the shareholders. But I give you an example, and because I'm going to ask you to read these points. But let me give you an example of how you are doing that discussion. So you see, when it comes to gearing is going to affect your liquidity, like we said, and also the credit rating, because if the gearing is high, then probably you have so much debt and you are probably facing issues of paying that debt if it falls due. So that is how it affects the credit rating. But at the same point, it also affects the shareholders, because shareholders don't like a company which has so much debt in it, because it increases their risk, and therefore the required return will increase. They will require more in terms of return. So which means that that same point is affecting the credit rating, but at the same time, the shareholders. And if you talk about the operating gearing, same thing, because those are explained the same way. So I'm going to share with you the solution to this so that you can see how many other points you can have made. But remember, you have 7 marks on this, plus some marks from this side. But usually most of these marks will go to the calculation. So you may be getting like 3. So that is 10 marks, basically 10 here, here 15. So what you need to realize here is that for you to get 10 marks, you are going to raise about 3 to 4 points, but explain them very well and discuss them, first of all, on the effect of the credit rating, but also on the shareholders. So basically, 1 point has to explain shareholders and credit rating. Then you go to another point. If you do that and you raise 45 points, you are in the clear on this question. So I don't know if there's any questions at this point. No. Okay. So this is going to be our last lesson, like I said yesterday. But I am going to still be available for any questions that can arise as you revise. So make sure that you go through, especially the major topics that section A numbers. If you see, how I used to do it in this case in the last moment is that I would go to the kit and look at every section A number and see what is unique about each of them. And I list down the unique points that are asked in them. Then I make sure that I understand all of them, because if you look at those questions, there's going to be so much repetition. So it's better to pick out what is unique from each, so that you have a list of things that you need to understand before the exam. Then you try to understand them either through the questions themselves or through the notes, but I would prefer to use questions because of the limited time that's left. Then you go to the section B numbers, do the same. Okay. All the while summarizing the theory parts that you find, because as I'm sure I should be doing already that, you're already doing that. So you have some summaries that you have with you for the theory parts, so that you utilize those ones and the questions that we have highlighted as being unique in section A for your revision. Make sure you know how to do NPV, discounted cash flows. Make sure you know how to deal with NPV when you have FX involved. Make sure you know how to deal with hedging, because there is a number section B that's going to always be there for hedging. And if you understand it, it's a short number, you can do it very fast and then do section A, or you do section A, do it very fast, then finish with the other number. depending on how easy the other number is. So if anything comes up as you revise, feel free to contact me. I don't know if you guys have been enrolled anywhere in the practice to pass webinars that the Pakistani guys usually put up. Have you?
No.
Okay, so in this case, maybe if you haven't, I'll try to see if I can get some, but in the meantime, I'll share with you a link to the previous ones so that you can at least use those previous ones if the new ones are not yet available. So, yeah, so thank you very much, and I wish you success in your exam. Feel free to contact me for anything.
Yeah, but
Thank you.
Yeah, bye.